Thank you for the kind introduction, Despina. As you mentioned, obviously at the moment, with markets the way they are, we are seeing quite a bit of volatility. News has always been a key part of financial markets, but obviously in the current climate, we are seeing a lot more volatility, a lot more things to consider when it comes to why the market moves the way it does. Now, one of the key things I want to focus on today, I know everybody here has probably attended some form of seminar in the past or something around Forex, introductory classes on Forex. And in all of these things, the one thing that we see, which usually happens, is that everybody talks about economic calendar, the usual what each news event is, especially high impact news, your NFP events, your interest rate decisions, and so forth, and the general impact that these usually have on currencies, commodities, indices, shares as well. The one thing I think that gets lost in translation with that is understanding news in context. Now, when I say context, I mean every few months, markets change. And when I say they change, certain events or certain macroeconomic factors are the key focus for financial markets. And with that in mind, just because we say when, for example, GDP release is positive for a country, we expect, for example, a positive GDP release for the United States should have positive implications for the US dollar. However, when markets are not focused specifically on the data and markets are being driven by other factors, like, for example, the current climate, we are seeing a lot of the movements around markets are mostly down to tariffs and the impact that's going to have moving forward over the next 12 months, then obviously GDP does not play such an important role anymore, or the role of GDP and the number is actually interpreted differently. And this is important. Understanding what's the current driver of markets is very important. For example, 18 months ago, we looked at inflation and everything was about inflation. So any data news or any news that came out that affected inflation and how markets priced in, rate cuts or rate hikes or how Federal Reserve and other central banks around the world were going to move going forward in terms of interest rate decisions. This was the main driving force for markets. And that was up until obviously February this year when we saw President Donald Trump take power in the United States. And this obviously led to markets now focusing solely on tariffs and the plans moving forward from the US, which obviously, as we all know, the United States is the biggest market in the world. And that obviously drives and has repercussions for every other obviously major economy in the world as well as ours, as well as a developing market. It's even more important. So when we think of these things, it's very important to understand context, which is what I really want to focus on today. So if we can, I do have a slideshow prepared as well. But like I said, a lot of this is going to be general things. The main part I want to focus on is when I do get to context, which I will focus on in a little bit more in detail shortly. Now, obviously, at the moment, one of the key things we are seeing, guys, like I mentioned, is the impact of understanding the context of markets. And with that in mind, what we have seen is the huge impact which we're seeing from comments being made by important people. At the moment, with the United States, we're looking at people like Donald Trump, US Treasury Secretary Scott Bessent. All of their comments around tariffs seem to be having a bigger impact on markets than any other data source that we're seeing at the moment. Now, understanding how to interpret that at the moment is probably the biggest driver for markets. And one of the things is, for those of you who don't know, probably I came from a technical analysis background. So when I started trading, everything for me was about technical analysis. For 3-4 years, that's all I focused on. That's all I worried about. I never ever gave any thoughts to data. Yes, sure, I did look at high impact events, but I tried to avoid trading these events solely because, like I said, it was just not something that I worried about so much. In the longer term trend of things, when you're trading or you swing trading, for example, like I used to do, with swing trading, one of the things you don't worry about so much when it comes to data is because my personal belief is that when data comes out, usually in the longer term trend of things, it just kind of supports the technical analysis, which I've already done when I'm looking from a weekly and a monthly and a longer term perspective. But when I got into technical analysis and when I joined Daily FX as an analyst, and what they focused on mostly was macroeconomic factors, which is why it became so important for me to understand these things. Now, looking at what we've seen recently, like I said, for example, with tweets, for example, Donald Trump being able to move the market so much, Scott Bessent being able to move the market so much, any trade deal announcements without the news or without a trade deal even being announced, what we are seeing is markets are then reacting and we're seeing positive risk sentiment for a short period of time. However, until the news or until trade deals are actually signed, what we need to understand in context is that these moves are going to be short-lived, right? And that's the key thing to understand right now when I say context. Now, I know we've got here filter noise versus real market movers, and that's basically what we're talking about here, is that if we get these comments out, it's not going to have a long-term impact on markets. It's going to be short-term moves. And understanding that in context means obviously now if you have a trade going at that point, if you are in the markets when the news comes out, understand that the potential is that you might get 20, 30 pip move in the one direction, positive news, but eventually the market will revert back to the current trend, which is that the overall market sentiment is still a bit doom and gloom because people are not certain yet that trade deals are going to come to fruition, right? So this is very important. Context is a very big part of understanding how the data is moving markets at the moment. Now, another thing that we're looking at is obviously at the moment there is a lot more sources of news which we are getting, right? So today with Twitter, we've got Truth Social, we've got all of these things. There's obviously a lot of different sources that we have to consider when we look at news. It's not just the actual number that comes out. Another thing that a lot of people miss is, for example, if we're looking at a GDP release or we're looking at S&P PMIs, these type of data events, if you read into the actual data, it always comes with the report. Right now, a lot of the times S&P will have analysts that will actually give comments on how this data or how they see this data impacting markets over the next 12 months, right? And this is what is driving market moves at the moment, not so much the actual data print, right? Just this week, we had US GDP, which came back and was revised as a second estimate down to 0.2 from April's initial figure, which was 0.3, negative 0.3%, obviously, contraction territory. Now, what we heard, obviously, when the initial data came out a month ago, US Treasury Secretary Scott Bessent, Fed Chair Powell said at the time that they expect the GDP to be upgraded. They don't expect it to remain at 0.3 negative in contraction territory. And what that did was the initial reaction to the news was one very negative. Obviously, the dollar struggled initially. But what we saw after that, once these comments came out, markets then reacted to what was said. And obviously, we saw a bit more positivity come into the US dollar as well. So these are the things that we need to consider when we're looking at these moves, especially in the current climate of markets, right? So like we say here, the unpredictable follow through, right? Initial price spikes at the moment are just not seeing that long-term follow through, right? So it's important to bear that in mind when you're thinking of context at the moment, okay? Now, moving on from there, obviously, one of the things that everybody asks me is how do I gauge sentiment in the morning? Right now, we South Africans, obviously, we're lucky. When we look at markets, we cover mostly the European session. We also get parts of the US session as well. So we get quite a lot of volatility during the day, right? Throughout the day, we're seeing quite a lot of volatility. We are managing to trade both of the major markets. And at times, we also get the overlap, obviously. The afternoon sessions for us South Africans, we cover UK and US markets. Right now, the main thing to consider when we're looking at it, the first thing I do every morning when I wake up is I look at what and how the market moved during the Asian session. Now, obviously, we all know we trade CFDs, the NASDAQ, the S&P, all of these things are still trading overnight, even though that's pre-market pricing. All brokers will price differently as well. But the one thing we can gauge from that is that we can gauge what's the actual sentiment. If US equities are obviously positive as we head into the Asian session, if we take a look at things like gold as well, we'll be able to see if gold has moved up or down in the Asian session. That would give me my first point of reference of how is market sentiment this morning. Then I will look at what news came out overnight. And when I say news now, guys, I'm not talking about data. We're talking about what has been said. Has there been any comments? Has there been anything from, especially when we're looking at the Asian session, we focus mostly on Japan. We're focusing on things like China, right? So these are the things that will be driving forces for markets heading into the European session until such time that we get some data in that European session, right? Because when we do get that data, like we said, there will be this short-term change that we will see probably for an hour or so. But at the end of the day, the sentiment, unless it is a big beat of a data print that is important or something like that, or we get something new out in the European session, maybe there's some rumors breaking that there might be a trade deal maybe, then these kind of things could then change sentiment for that session, right? But generally, markets will tend to continue on from the previous session and take that sentiment into the next session, right? So these are the things that I normally look at early in the morning. This is very important. It gives me an idea of what I'm looking at. I'm sure many of us here have placed trades over the last 18 months, where what we've seen is that we wake up in the morning, we have a very nice technical setup, we take the trade, and then all of a sudden it doesn't go in our favor. And then we sit there and we wonder why, like what is affecting sentiment so much? And we don't know where to look for these things. We don't know where to find the data, where to find any news, right? So these are the things. Look, there's a lot of sources out there for news. I do have a few in the slides here shortly. We will go through them. But like I said, it comes down to just have to look around, right? We look at things like Bloomberg. We look at things like what is the market performance. You don't necessarily need to read too many articles or things like that to find this. It's more about how has the markets performed during the Asian session, right? Very important. It gives me a guide. And that works the same way as we head into the US session. All right. So if the European session is seeing positive sentiment, we are seeing, we are seeing a lot of positive moves for things like US equities. We are seeing a positive US dollar or stronger US dollar, then that is likely to continue as the US session opens until we get some change in the data or we get some change in market sentiment overall. Okay. Now, like I said, context, very important, guys. This is something that we really need to focus on. I think um, if we take into account the one thing I always like to look back on and refer to is, I don't know if there's many people in this room who were trading or who were active in financial markets in 2008. I highly doubt it, but I'm sure many of you have heard about the movie The Big Short. I'm sure many people have watched that movie. And the one thing that that movie teaches us is that at the end of the day, it's not data that trades markets. It's people. And people have emotions, right? So as much as we think that a data print is positive, when it comes to certain things, people will look at it and will say, sometimes people just don't buy into the data, right? This is something that we always hear about a place like China. Whenever Chinese data comes out, people question whether the data is authentic, whether the data can be trusted, all right? Now, up until 2008, when everybody looked at the United States, we looked at it as the pinnacle of financial data, very trusted source. And big banks never questioned that something as big as the housing market, which was the bedrock of obviously financial markets, modern day financial markets, the mortgage market, that it could collapse, right? So obviously, when that actually came to fruition and that actually happened, everybody was caught with their pants down. Forgive me for a lack of a better analogy there, but that's basically what happened, right? And that these are things that repeat themselves. So the one thing with financial markets is the longer you stay in it, certain trends tend to repeat themselves, right? So everybody talks about every 10 years or every 15 years or 20 years, we will get a recession, right? And people sometimes prep for that for a long time. The problem is timing such things in markets, even with data, even with news, it sometimes never, you will never be able to get the timing right. This is the difficult part, right? So which is why with us as day traders, mostly as even swing traders, shorter term, we don't have the luxury of obviously holding positions for 3 years and waiting for it to pay off, right? But it still has an effect. In between those 3 years, you will get swings up and down, which is what happened in 2008, which is what happened post-COVID as well. When markets came back into fruition, when markets came back from the slump of COVID, we saw a lot of back and forth moves as data came out, as the economies around the world got more optimistic about the outlook. We saw a lot of fluctuation, a lot of volatility. So very important to consider all of these things as well. Okay. Now, besides that, obviously at the moment, with the volatility that we have, some of the positives that we can look for, some of the opportunities that we may find is that there is obviously a lot more opportunity to make money. There's a lot more volatility, right? Volatility for traders is very important. It's what we thrive on, right? But the thing is, with volatility and more, the opportunity to make more also comes the opportunity to lose more, right? So the general topic that everybody talks about is managing risk, right? So one of the things that I find that works best for me during times of high volatility is I try to minimize my risk, not by just stop loss or whatever we normally say, but like I try to half position sizes. So what I will do is during volatile times, I will look for moves. I will try to average in a price. So I will look at, because especially like we said, with short-term moves that we get around individual news releases, I will try and average in half my position maybe before the news. And then when the news comes out, if that price gets worse for me, for example, if I'm looking to buy gold at 3,300 an ounce, if gold comes down to 32.80, but my overall bias is still bullish, I will look to averaging at 32.80. Now, obviously, I do still have a stop loss in mind, whether that's 32.70, 32.60. That comes down to everybody's own risk appetite, obviously. That's something that you need to. I'm not saying don't trade with a stop loss. Please don't think that that's what I'm getting at. But what I'm saying is that's how I approach things in times like this, right? So that's what has worked for me as well. And that's what I see a lot of the traders actually do find that it works for them as well, having spoken to many. So these are things that I always try to look at. Now, besides that, guys, we are in the age of data, right? So now I've been talking a lot about tweets and not actually looking at data, but there are tools today and there are a lot of companies that have come up, which today is providing us as retail traders with data that we would have never had access to 5 years ago, let alone 10 or 15 years ago, right? When I started trading 8, 9 years ago, when I got into this industry, most of the data that I really wanted, I couldn't get access to because the price for, let's say, a Bloomberg terminal or a LSEG workspace is in the thousands, $30,000, $40,000 a year, right? Most of us retail traders, we cannot afford to get access to that data, right? Now, people always talk about an edge in trading, right? I am a believer that there are certain things that you can use to improve and obviously get that data. And today we have those tools available. A lot of it is free. A lot of it is within a decent price range. So it makes it accessible for us as retail traders. One of the things that I've used a lot of in recent years, I'm not sure if many of you have heard of it. It's a new website. It's only about 12 months old. It's called Edgeful. A really exciting tool. Edgeful provides a lot of data, which I have access to now because obviously I work for OANDA, so I have an LSEG workspace. But personally, I was already using Edgeful before I joined OANDA. So it gave me access to data, things like, it would give me access to things like, some of what I use is basically average market moves on a day, for example, something like the NASDAQ. I know how popular the NASDAQ is in South Africa. Now, if I can find average ranges per day, we can do that ourselves, search for data like that. We can actually curate data like that ourselves by going back for the last 6 months, but that's going to take us time. A lot of us work and trade at the same time. So obviously to do that, it is time consuming. A lot of us have family lives. It's not feasible to do this ourselves, right? Edgeful provides all of that data done for you. You can scale back as far as 5 years, and it will give you the average moves on a Monday, Tuesday, Wednesday, Thursday, Friday. Right now, obviously, if something like the NASDAQ is scheduled to move 300 points on every Tuesday over the last 5 years, that gives you an idea on a Tuesday when you are looking at the NASDAQ. If it's already dropped 300 points, then you can combine that now with technical analysis, look at how the market sentiment is. There's a chance that after a 300-point move to the downside, the NASDAQ's going to bounce because that's the average that it moves on a Tuesday. It's not going to move more. All right, so we work on these kind of things. These are the type of tools that can give us an edge in the current market climate. Okay, so these are obviously important tools to consider. Besides that, obviously, a lot of new sources. Like we said, you got Forex Live, I know, which is FX Finance Magnates as well, part of the Finance Magnates family. Myself personally, I write for MarketPulse. We do articles daily there as well. FX Street, one of the biggest news sources around financial markets, 400 articles a week. These type of things, I know that everybody's style of trading is different. But personally, you will always find somebody who resonates with you, right? And that's important. You need to find somebody whose trading style gives you a sense of, okay, I can relate to this person, right? It's no point trying to understand somebody that maybe your trading style and his trading style is completely different. It will never be of benefit to you because you will always second guess your own trading, and then it's not going to give you any benefit, right? It was something I spoke with Nkateko that's sitting here in front today. We spoke about it yesterday. I'm a firm believer that everybody needs to find their own style, right? And another thing that I think often gets overlooked with trading, it's the last point I would like to just make for everybody here, is everybody talks about, trading should be sort of a step-by-step. You should have your 5 steps or 6 steps for execution. Take a trade based on if my 5, 6 rules are met, right? But as I said earlier, people trade the markets, right? So as much as that, we are not robots at the end of the day. There is nothing better than human gut feeling, personal belief, whether you agree with me or not. If you are confident in a trade, 4 of your 5 steps are met, but your gut feeling tells you this trade is going to work out, trust your gut. It's no point trusting the next guy. You don't know what his outlook on markets is, how he sees things. You have no idea. So it's kind of pointless if you don't speak to that person regularly or understand what they are looking for. Following somebody else blindly or following somebody who you think is a proper trader or who is making a lot of money is not going to benefit you short term or long term. Okay, so I thought I'd leave everyone with that gut feeling, one of my strongest beliefs in trading. So I hope it added a bit of value, but if anybody would like to talk more about context, I'm going to be here for the rest of the day. I'm happy to share anything and any questions. Unfortunately, time was short, so I didn't get a chance to take any questions, but I'm willing to do that after. Okay, thank you so much. Appreciate it.